Victoria, I'm going to use your data and quote it back to you. The markets are up 65% from the March lows in just 179 days. That is great for your clients. It's great for our viewers and listeners. But why isn't it just a little too far, too fast?
But, you know, I'm not sure it has, because this looks like a classic recovery off of a bear market. You know, if you chart this versus what happened in 2009, it rallied 66% off the March 9 lows going into the end of the year. And then going forward in 2010, it produced about another 15% return. You also look at 2016, which was a nice, strong bull market rally. People realized there was a bull market. And in 17, you were looking at another 13, 15%. And the average street target really around 4,200 for year end next year on the S&P 500, which puts it right squarely in the 13.5% potential return. So we think this is just a classic rally off a bear market, a bull market recovery. And look, the markets never tell you, hey, come invest in me, it's safe now. It's always going to feel weird. It's always going to feel overvalued because you're coming off of these huge lows. So everything looks expensive off the lows. But if you back it out and look what might happen with EPS growth, you realize it's actually probably not as bad as you think it is, and there is still room for it to run next year.
Is the market pricing in stimulus? If we don't get something of any size, will stocks decline?
Yeah, you have a potential for a short-term hit if you don't get something done in the next couple of weeks. Certainly, they're stuck a little bit on that, or the defense spending bill. But I actually have faith that we can have some adults in the room that get it done, because people are really hurting. You know, locally, we're seeing restaurants continue to have to shut its doors. It's heartbreaking for a lot of people. And I think if push comes to shove, government is going to try to help. They are going to get something through. It may not look like the first round. You know, there's talk that the $1,200 direct payments are certainly not on the table, but you could look at extra unemployment benefits and other ways to directly help small businesses, which are feeling the brunt. And I actually have faith it'll get done before we go to Christmas, and that's going to help people get through the holiday season.
I looked at some of the stocks you like, and I kind of did a double take. I was looking at the notes, Victoria, and I saw CVX. Oh, yeah, that's Chevron. Wait a minute, Chevron? Chevron? I know you're in Texas.
I know.
I thought fossil fuels were buried. Dinosaur juice.
Well, you know, it's the death of the energy industry is a little over-exaggerated. Look, in an early cycle rally, you want to have some cyclicals. We think energy is still undervalued, and Chevron is the crown jewel of the energy industry. It's a 5.5 yield. You know, they have very disciplined spending cuts. Their CapEx is only about $14 billion next year. Oil in the 40s is definitely good for them. I think their break even next year is like 48. And look, they picked up Noble for cheap. They definitely won by losing the Anadarko race in 2019, and they've got this great complementary company now they're merging with Noble. And Chevron's just a fantastic company. You know, its Permian acreage is the darling of the street. And you look at it and say, if I want to buy something that's maybe not as expensive, you know, and I need to look at other pockets of the market, energy is certainly a beaten down sector. And OPEC kind of played nice. They actually came to an agreement. It is adding 500,000 barrels per day, but that's better than no OPEC agreement. And I know people are worried, you know, what happens if there's another black swan? But look, that's like saying, hey, I'm not going to go to the gym because I could sprain my ankle. You know, investing involves risk, and we think this is an undervalued sector and a good balance sheet, strong cash flow, and a CEO that's going to defend the dividend to the hilt.
Yeah, and I was saying that OPEC Plus decision was really a gift, if you will, to the U.S. oil and gas industry, because they kept prices somewhat firm very quickly. Bonus final pick, why do you like CrowdStrike?
Oh, they're a fantastic tech company. They crushed earnings last week, and they're just they're cloud-based, and with all the workforce getting dispersed and everybody working from home, people need a better way of monitoring. They're AI and cloud-based, and the sector itself is going to continue to grow. Cybersecurity is a sector that people are going to have to continue to put more money behind, and their product is just superior. Plus, their revenue, they're anticipating almost 70% potential revenue growth next year, and they're learning to increase their subscription types across the client base. And they're picking up some big wins. They picked up Target. You know, they're eating into the market share of a growing market, and that's just the company you want to be a part of.
Shepard Smith here. Thanks for watching CNBC on YouTube.